Welcome to this explainer. If you follow the regional banking sector, you already know that finding a genuinely insulated deposit base is, well, it's pretty much like finding a needle in a haystack. But today, we're unpacking the Q2 2026 data and regional market position of Central Pacific Financial to uncover what makes this particular bank so incredibly unique. We're going to look closely at the numbers, the credit quality, and the independent ratings to see exactly how CPF leverages its geographic reality to its absolute advantage. Here is our roadmap for today. We'll be hitting the Hawaiian banking moat, the Q2 2026 financial results, dividend yield and consistency, credit quality and risks, and finally, the Fitch ratings outlook. Let's get right into it.
Section 1, the Hawaiian banking moat, a legacy of stability.
To truly grasp Central Pacific Financial's financials, you first have to understand the completely unique market landscape they operate in. Grounded in a rich history since 1954, Central Pacific Bank was actually founded by Japanese-American World War II veterans. Their goal was to serve families and small businesses that just didn't have access to traditional financial services back then. Fast forward to today, and they've grown into the fourth largest financial institution by deposit base in Hawaii, operating 27 branches and 56 ATMs across the state. This deep community integration is a massive reason why they were recently named the best bank in Hawaii by Forbes magazine for the third consecutive year. It's fundamentally a relationship-based model built on decades of trust.
Now look at this number, because it's absolutely staggering. The top 4 banks in Hawaii hold 93% of the total deposit market share. Just think about that level of concentration for a second. On the mainland, regional banks are constantly fighting off dozens of competitors for every single deposit dollar. But in Hawaii, 4 institutions have effectively captured the entire market.
And this is exactly what creates CPF's true moat. As Fitch Ratings points out, this highly concentrated insular market creates incredibly stable, low-cost funding that completely insulates the bank from mainland volatility. Because competition for deposits is so rational and contained among these top 4 players, they literally don't have to engage in those aggressive, margin-crushing deposit pricing wars we see everywhere else. This structural advantage, it's the absolute bedrock of everything we're about to see in their financial results. Which brings us to Section 2, Q2 2026 financial results, steady momentum. With that market context in mind, let's see how this moat actually translated into earnings. The bank delivered a remarkably strong quarter. Net income hit $20.8 million, and their diluted earnings per share climbed to 80 cents. That's a 19% jump year over year. Fantastic growth that actually beat Wall Street estimates. Their return on average assets was a solid 1.12%, with return on average equity at 13.94%. But here's the best part. Total deposits remained incredibly stable at $6.7 billion. This proves that their core deposit base, which is over 90% of their total deposits, simply isn't chasing yields elsewhere.
So the crucial takeaway here is that their net interest margin actually expanded by 4 basis points to 3.57%. In an environment where so many banks are seeing margins squeezed, CPF is expanding theirs. Why? It all comes back to those low-cost Hawaiian deposits we just talked about. As Chief Financial Officer Dana Matsumoto noted on the earnings call, deposit pricing continues to be very rational in Hawaii, allowing them to benefit from higher yields on new loans without having to dramatically hike what they pay out to depositors.
Furthermore, management continues to confidently return capital to shareholders. They aren't just hoarding cash. They are actively buying back their own stock. In the second quarter alone, they repurchased over 321,000 shares for roughly $11.3 million. Data shows they've been decreasing their outstanding share count by about 1.39% annually over the past 3 years. That effectively increases the ownership slice for existing shareholders and gives a really nice tailwind to earnings per share. Section 3, Dividend Yield and Consistency, the Income Investor's Lens. Let's shift gears to a topic that is definitely top of mind for retail investors. When we compare CPF's dividend metrics to global regional peers using data from ValueRay, a distinct profile emerges. The bank offers a moderate dividend yield of 3.52%, and they actually just raised the payout by 3.4% to 30 cents per share for the third quarter. Sure, some peers offer higher yields, like BPR Banca, nearing 6%, but yield is only one piece of the puzzle, right? What really matters for long-term holding is sustainability. To give you a balanced view, let's break down the green and red flags. The undeniable green flags here are safety and reliability. They have a highly conservative 36.7% payout ratio, meaning they only pay out about a third of their earnings as dividends. That leaves a massive cushion to maintain the dividend even if a severe recession hits. They also boast an incredible 98.3% lifetime payout consistency score. But we have to call out the red flags, too. The 5-year compound annual growth rate for their dividend is a very weak 1.9%. That fails to outpace inflation, meaning the real purchasing power of this dividend is technically shrinking over time.
Moving to Section 4, Credit Quality and Risks, Looking Under the Hood.
Now, no financial analysis is complete without a thorough search for risk, especially in commercial real estate. During the Q2 earnings call, management proactively disclosed a bit of turbulence. They revealed that a $20 million mainland real estate loan was recently downgraded due to an ownership dispute and some financial difficulties with the principal guarantor. Anytime a $20 million loan gets downgraded, it immediately raises a valid question. Is this a crack in the foundation? Should investors be worried? Fortunately, a deeper look shows why management isn't exactly losing sleep over this. While the probability of default did increase, triggering the downgrade, the bank expects zero actual loss on the principal. Why? Because the loan is fortified by highly conservative underwriting. We're talking a 57% loan-to-value ratio, meaning the underlying real estate is worth nearly double the loan amount. Plus, it has a strong 1.27 times debt service coverage and diverse third-party leasing. This perfectly illustrates their disciplined asset deployment. Even when a loan hits a rough patch, the structural protections prevent capital destruction.
Finally, Section 5, the Fitch Ratings Outlook and Independent Assessment. Let's wrap up by seeing how independent rating agencies view all this. Fitch Ratings recently affirmed the bank at a solid BBB with a stable outlook, closely aligning with what we've covered today. They specifically praised CPF's strong deposit franchise and that 11 to 12% market share in Hawaii. They also highlighted the incredibly low credit loss ratio. In the first quarter of 2026, CPF's impaired loans to gross loans ratio was just 30 basis points, exceptionally low. Now, Fitch did mention some duration mismatch risk, meaning long-term real estate loans funded by deposits that could technically leave. But again, because those Hawaiian deposits are so incredibly sticky, the risk is heavily mitigated. Looking ahead, Fitch anticipates the bank's core capital, the CET1 ratio, will comfortably normalize to an 11 to 12% range, perfectly positioning them to support loan growth and those shareholder returns.
So what does this all mean? We have a fascinating profile here. On one hand, you have a dividend growth rate lagging behind inflation, which might deter aggressive growth investors. But on the other hand, you have an ironclad Hawaiian banking moat that practically guarantees ultra-low funding costs, near-perfect dividend consistency, and highly disciplined risk management. So balancing all these factors, we have to ask, does a remarkably stable, slow, and steady earner like Central Pacific Financial fit into your specific investment strategy? That is the ultimate question you'll need to answer for your own portfolio. Thanks so much for joining me on this explainer, and keep learning.